Let me begin with a simple but uncomfortable question. When something as old and fundamental as silver starts behaving in new and unusual ways, are we witnessing random market noise or the early signals of a deeper structural change? History teaches us that monetary systems do not collapse overnight. They erode quietly under pressure, while most people are distracted by daily headlines. And that is why the question before us today, are they setting up a new silver monetary system, deserves serious, sober analysis. Not hype, not fear, but clear economic thinking. For decades, we have been told that precious metals are relics of the past, replaced by sophisticated financial instruments, digital money, and central bank credibility. Yet, paradoxically, silver keeps reappearing at the center of strategic decisions by governments, industries, and financial institutions. That contradiction alone should make us pause. When official narratives and real-world behavior diverge, economists must ask why. Silver occupies a position in the global economy that is both rare and deeply unstable because it exists at the intersection of two powerful and often competing forces. On one side, it functions as a critical industrial input, essential to the physical operation of modern economies. On the other, it operates as a monetary and financial asset, historically trusted as a store of value during periods of uncertainty. When a single material is pulled simultaneously by these two forces, the result is not balance, but pressure, and that pressure is now becoming impossible to ignore. What makes silver especially significant is that, unlike gold, it is not primarily hoarded and stored away. The majority of silver mined each year is consumed. It disappears into solar panels, electric vehicles, medical instruments, semiconductors, military hardware, and telecommunications infrastructure. Once used, much of it is not economically recoverable. This means that industrial demand for silver is not cyclical in the traditional sense. It is structural. As economies commit to electrification, digitalization, and renewable energy transitions, silver demand is effectively locked in, regardless of short-term price movements. That reality alone challenges the idea that silver can continue to be treated like just another tradable commodity. At the same time, silver carries centuries of monetary history. In moments when confidence in paper assets weakens, silver reasserts itself as a hedge against inflation, currency debasement, and financial instability. Investors do not turn to silver because they romanticize the past. They do so because silver represents something modern finance struggles to provide: tangible scarcity. When central banks expand balance sheets and governments accumulate unpayable debts, assets that cannot be created by policy decree take on renewed importance. Silver's monetary demand, therefore, rises precisely when economic stress intensifies. Here is the critical hook: these two forms of demand do not merely add together, they collide. Industrial users require stable, predictable supply at manageable prices. Monetary demand, however, thrives on uncertainty, scarcity, and volatility. When investors begin accumulating silver as a hedge, they remove physical metal from circulation, tightening supply for industry. When industry expands, it consumes silver permanently, reducing the stock available for monetary purposes. This is not a temporary imbalance, it is a structural contradiction embedded within the metal itself. The supply side offers little relief. Silver is rarely mined on its own. It is typically a byproduct of mining for copper, lead, zinc, and gold. This means silver supply does not respond quickly or directly to rising silver prices. Even significant price increases may not lead to proportional increases in production because mining decisions are driven by other metals. As a result, the market lacks a self-correcting mechanism. Demand can surge, but supply remains stubbornly inelastic. In economic terms, this is a recipe for sustained tension rather than equilibrium. Another often overlooked factor is the increasing strategic importance of silver to national economies. When silver becomes essential to energy security, technological competitiveness, and defense systems, it is no longer merely an input, it becomes a strategic resource. Governments may tolerate price volatility in financial markets, but they are far less comfortable with shortages of critical materials. This raises the possibility of stockpiling, export restrictions, or preferential access for domestic industries, all of which further tighten global supply. The deeper implication is that silver's pricing mechanism may be fundamentally misaligned with its economic role. Markets continue to price silver largely through financial speculation and short-term trading while ignoring long-term consumption and strategic demand. This disconnect creates vulnerability. When reality asserts itself, through shortages, delivery failures, or geopolitical disruptions, the adjustment is rarely smooth or gradual. It is sudden, disruptive, and often painful for those who assume the system would behave as it always has. Silver, then, is not simply undervalued or misunderstood. It is structurally constrained by its own importance. The more modern economies depend on it, the less flexible its supply becomes. The more unstable financial systems grow, the more attractive it becomes as a monetary refuge. These forces are now converging, not in theory, but in real time. And when a material becomes simultaneously indispensable to production and desirable as money, the question is no longer whether pressure will build, but where and how it will ultimately be released. Modern economies are being reshaped by a monetary experiment of historic scale, one that few policymakers are willing to describe honestly. Over the last 2 decades, and especially since the global financial crisis, fiat currencies have been produced in volumes that would once have been considered unthinkable. Central banks have expanded balance sheets, suppressed interest rates, and normalized emergency measures as permanent policy tools. The justification has always been stability and growth, yet the lived experience for many households has been rising prices, declining purchasing power, and deepening insecurity. When money itself becomes abundant, trust in its value begins to erode. This erosion is not dramatic at first. It does not arrive as a collapse, but as a slow, grinding loss of confidence. Savings buy less. Wages lag behind inflation. Asset prices inflate beyond the reach of those who rely on income rather than ownership. In such an environment, people do not need to be economists to sense that something is wrong. They may not articulate it in technical language, but they respond rationally by seeking assets that stand outside the machinery of monetary creation. This is where hard asset logic quietly reasserts itself. Silver enters this space not because it is perfect, but because it embodies constraint. It cannot be printed, voted into existence, or conjured through accounting entries. Every ounce requires physical extraction, energy, labor, and time. In an economic system increasingly dominated by abstractions, derivatives, leverage, and digital claims, this physical limitation becomes a feature rather than a flaw. The hook is simple but powerful. When everything else can be created in unlimited supply, scarcity itself becomes valuable. The expansion of fiat money also alters incentives at the institutional level. Ultra-low interest rates encourage borrowing, speculation, and financial engineering rather than productive investment. Governments roll over debt instead of confronting structural imbalances. Corporations prioritize share buybacks over wage growth. These outcomes are not accidental. They are the predictable consequences of a system that rewards access to cheap money. Over time, however, such a system undermines its own legitimacy. When economic rewards appear disconnected from work, productivity, or social contribution, confidence in the currency that mediates those rewards weakens. Historically, moments like this have triggered a renewed interest in monetary anchors. Not because societies wish to return to the past, but because unconstrained money eventually exposes its own limits. Gold has traditionally played this role, but silver offers a different, and in some ways more revealing, signal. Its lower price point makes it accessible beyond elite investors, and its industrial importance ties it directly to real economic activity. When silver demand rises alongside monetary expansion, it reflects not speculation alone, but a broader discomfort with the direction of policy. Another hook lies in the contradiction between official rhetoric and institutional behavior. Central banks publicly insist that inflation is manageable and that fiat systems remain sound. Yet, at the same time, they hold reserves of hard assets, diversify away from single currencies, and quietly prepare for volatility. This divergence between what is said and what is done is not trivial. In economics, behavior reveals beliefs more accurately than statements. When institutions hedge against their own policies, the message is unmistakable. The revival of hard asset logic also exposes a deeper political tension. Fiat money systems rely heavily on trust that authorities will act responsibly, that inflation will remain contained, and that future value will be preserved. When that trust weakens, the system does not merely face an economic challenge, but a social one. People begin to question not just prices, but fairness. Who benefits from money creation? Who pays the cost? These questions push individuals and institutions alike toward assets that sit outside political discretion. Silver, in this context, functions less as a speculative bet and more as a referendum on monetary credibility. Each ounce accumulated is, in effect, a quiet vote of no confidence in unlimited currency creation. As fiat expansion continues, the logic driving this behavior strengthens rather than fades. The system can delay consequences, but it cannot repeal them. And as history repeatedly demonstrates, when confidence in money weakens, societies do not abandon value, they redefine where it resides. The modern silver market presents a paradox that would be impossible to sustain in most other sectors of the economy. An enormous volume of financial claims exists on a relatively small and finite pool of physical metal. Futures contracts, options, exchange-traded products, and unallocated accounts have created a paper-silver universe that dwarfs the amount of silver that can actually be delivered. Under normal conditions, this structure appears stable, even efficient. But economics teaches us that systems built on confidence rather than capacity remain functional only as long as that confidence is never seriously tested. Paper silver markets were originally designed to provide liquidity, price discovery, and risk management for producers and consumers. In theory, they smooth volatility and allow participants to hedge exposure. In practice, they have evolved into something far larger and more abstract. Financial actors with no intention of taking delivery dominate trading volumes, while physical silver quietly moves in the background, largely disconnected from the price signals generated by these markets. This disconnect is the first hook prices are being set by claims, not by metal. The scale of leverage embedded in paper silver is striking. A single ounce of physical silver can underpin dozens, sometimes hundreds, of paper claims. As long as most participants are content to settle in cash rather than metal, the system holds. But this stability is conditional, not structural. It depends on the assumption that physical delivery will remain a marginal event rather than a central demand. Economics warns us that when assumptions become widespread and unquestioned, they are precisely the ones most vulnerable to sudden reversal. What changes the equation is stress, monetary, geopolitical, or institutional. When inflation rises, currencies weaken, or trust in financial intermediaries erodes, incentives shift. Participants who once treated silver exposure as a paper trade begin to ask a different question: can I actually get the metal? At that point, the distinction between paper and physical silver stops being theoretical and becomes decisive. If even a small percentage of paper holders demand delivery simultaneously, the system faces a problem it is not designed to solve. Another hook lies in the asymmetry of outcomes. If confidence holds, paper markets continue to function with little disruption. But if confidence breaks, the adjustment is not gradual. There is no smooth mechanism for reconciling excess claims with limited supply. Prices must rise sharply to ration demand, contracts may be settled involuntarily in cash, and legal frameworks are tested under pressure. In such moments, market participants discover that liquidity is abundant until it isn't, and then it vanishes all at once. This dynamic exposes a deeper structural risk. Paper-silver markets depend on the belief that financial claims are equivalent to physical ownership. Yet, from an economic standpoint, they are fundamentally different goods. Physical silver eliminates counterparty risk, paper silver concentrates it. When financial systems are stable, this distinction is ignored. When instability emerges, it becomes everything. The repricing that follows is not simply about silver, it is about trust itself. There is also an institutional dimension to this imbalance. Large financial entities benefit from deep, liquid paper markets that allow for short selling, leverage, and complex strategies. These practices can suppress volatility and, at times, prices. Physical market participants, miners, manufacturers, and long-term holders operate under entirely different constraints. They cannot create silver through contracts. They must deal with geology, energy costs, labor, and logistics. When paper markets dominate price discovery, the real economy is forced to accept signals generated by financial abstraction rather than material reality. As physical demand grows from industry, from investors seeking delivery, from governments securing resources, the tension intensifies. Paper markets can expand indefinitely, physical supply cannot. This is not a moral argument, but a mathematical one. Eventually, the gap demands resolution. Either confidence in paper claims remains intact, or the market is forced to re-anchor prices to physical availability. The critical insight is that such transitions are rarely announced. They unfold through delivery delays, inventory drawdowns, rule changes, and temporary suspensions that quietly become permanent. Each event chips away at confidence, nudging more participants toward physical ownership and further straining the system. In this sense, the silver market does not need a dramatic failure to change fundamentally. It only needs enough doubt to remind participants of a basic economic truth: claims are only as strong as the assets behind them, and scarcity always asserts itself in the end. The global economic order is entering a phase defined less by integration and more by fragmentation, and this shift is quietly reshaping how nations think about money, trade, and power. For decades, the dominance of the US dollar provided a common language for global commerce. It reduced transaction costs, stabilized trade flows, and gave the United States extraordinary influence over the world economy. But that system was built on trust. Trust in political stability, fiscal discipline, and the neutrality of financial infrastructure. As that trust weakens, countries do not protest loudly, they adapt strategically. The first hook is this: de-dollarization is not an ideological rebellion, it is a risk management strategy. When nations see reserves frozen, sanctions weaponized, and payment systems used as geopolitical tools, they reassess exposure. No responsible state wants its trade, energy security, or currency stability to depend entirely on another nation's policy decisions. As a result, countries are diversifying reserves, experimenting with local currency trade, and, crucially, turning toward commodities as neutral settlement tools. Commodities change the logic of trade because they are not promises, they are physical realities. Oil, gas, grain, copper, and increasingly silver represent value that exists outside financial systems. When two nations settle trade using commodities, they reduce counterparty risk and political vulnerability. Silver fits neatly into this framework because it combines high value density with universal recognition. It is small enough to move, scarce enough to matter, and historically accepted as money across cultures and centuries. That history is not symbolic, it is functional. Another hook lies in the structure of emerging trade agreements. Bilateral and regional deals increasingly bypass traditional reserve currencies and rely on direct exchanges, clearing mechanisms, or commodity-linked settlements. In such systems, silver does not need to become official money to gain monetary relevance. It simply needs to function as collateral, reserve backing, or confidence anchor. This subtle role allows silver to support trade without challenging existing systems openly, making it politically convenient as well as economically useful. Geopolitical fragmentation also increases demand for strategic stockpiles. When supply chains were global and stable, efficiency was the priority. In a fragmented world, resilience replaces efficiency. Governments now care less about just in-time delivery and more about guaranteed access. Silver's importance to electronics, energy infrastructure, and defense technologies elevates it from a market input to a national asset. Once a commodity enters that category, it is no longer left entirely to market forces. There is also a power dynamic embedded in commodity-backed trade that often goes unspoken. Financial systems reward those who control currencies and institutions. Commodity systems reward those who control resources. As the global order becomes more multipolar, resource control gains importance relative to financial dominance. Silver-producing nations or those with secure access to it gain leverage in negotiations. This shifts influence away from purely financial centers toward the real economy of extraction, production, and logistics. The contradiction here is striking. Many policymakers publicly defend the existing monetary order while simultaneously preparing for alternatives. They speak the language of stability while building parallel systems. This is not hypocrisy, it is realism. In times of transition, institutions hedge. Commodity-backed mechanisms are not meant to replace the dollar overnight, but to reduce exposure gradually. Silver's role in this process is quiet, incremental, and therefore easily underestimated. Another hook emerges when we consider crisis scenarios. In periods of financial stress, currencies can be devalued, payment systems disrupted, and credit frozen. Commodities retain functionality. They can be pledged, exchanged, and stored without reliance on digital infrastructure or foreign institutions. Silver's liquidity and divisibility make it particularly adaptable in such contexts. These characteristics are not theoretical, they are precisely why silver has emerged repeatedly throughout history during periods of systemic stress. As geopolitical blocs solidify and trust between them diminishes, the logic of neutral settlement becomes stronger, not weaker. Silver does not belong to any one nation's central bank policy. It carries no default risk, no political allegiance, and no expiration date. In a fragmented world economy, those traits are not nostalgic, they are strategic. And as trade systems evolve to reflect this new reality, silver's role expands not through declarations, but through necessity. One transaction, one reserve decision, and one quiet policy shift at a time. Monetary systems are never neutral mechanisms. They are instruments of power that determine who benefits from economic activity and who bears its costs. When the structure of money changes, the distribution of power changes with it. This is the hook many people miss. Debates about silver, currency, or monetary reform are not abstract discussions about metals or markets. They are arguments about who controls value in society and who does not. Under a fiat-dominated financial system, power tends to concentrate around institutions that control credit creation. Banks, large financial firms, and asset holders benefit disproportionately because they gain early access to newly created money. This is not a conspiracy, it is a structural feature. When money is injected into the economy through financial channels, those closest to those channels benefit first. Asset prices rise before wages do. Debt becomes easier to manage for institutions, while households struggle with rising living costs. Over time, inequality is not an accident, but an outcome. A monetary shift that restores importance to tangible assets like silver disrupts this arrangement. Silver cannot be created by financial engineering or balance sheet expansion. Its value is tied to extraction, production, and physical availability. This reintroduces limits into a system that has grown accustomed to operating without them. The hook here is simple, but uncomfortable limits reduce the power of those who profit from excess. Financialized economies thrive on abstraction. Derivatives, Leverage and complex instruments allow enormous wealth to be generated without corresponding increases in real production. When monetary systems favor these abstractions, they reward financial sophistication over material contribution. A greater role for silver, even indirectly, tilts the balance back toward the real economy. Those who mine, refine, manufacture, and secure physical resources gain relevance, while purely speculative advantages weaken. This redistribution is not merely economic, it is social. Workers and producers often find themselves on the losing end of fiat expansion, as inflation erodes purchasing power faster than wages adjust. Savings lose value, while debt-backed asset owners remain protected. When money reconnects, even partially, to hard constraints, this dynamic shifts. Inflation becomes harder to sustain without consequence. Policymakers face trade-offs they can no longer postpone. The cost of mismanagement become visible rather than hidden. Another hook lies in how monetary shifts expose dependency. Financial elites rely on trust in institutions, markets, and rules. Physical asset holders rely on custody and control. When confidence in systems weakens, the advantage moves away from intermediaries and toward those who hold tangible value. This does not eliminate inequality, but it changes its shape. Power migrates from balance sheets to stockpiles, from paper claims to physical control. There is also a geopolitical dimension to this redistribution. Nations that dominate financial systems exert influence without producing proportionate material output. Commodity-based influence operates differently. It rewards those who control resources, logistics, and supply chains. As silver gains strategic importance, countries with access to it gain leverage, while those dependent on financial dominance alone face new vulnerabilities. This shift challenges long-standing hierarchies in the global economy. The resistance to such change is predictable. Monetary systems that benefit powerful actors are defended with intellectual, political, and institutional force. Calls for reform are often dismissed as impractical or regressive. Yet history shows that monetary arrangements persist only as long as they manage social tension effectively. When inequality widens and legitimacy erodes, systems adjust, not because reform is embraced, but because it becomes unavoidable. Silver's relevance in this context is not about returning to a past ideal, but about revealing present contradictions. It highlights how far modern economies have drifted from production towards speculation. It reminds societies that value ultimately rests on real goods, real labor, and real limits. The moment a system begins to acknowledge those limits, even indirectly, power begins to redistribute. What makes this moment particularly significant is its subtlety. Power is not shifting through revolution or decree, but through incentives. Investors diversify. Governments hedge. Institutions quietly prepare. Each decision seems rational in isolation, but collectively they signal a rebalancing away from financial dominance toward material grounding. Monetary shifts rarely announce themselves as moral corrections. They operate as quiet realignments, reshaping who holds influence, who absorbs risk, and who ultimately defines what is considered valuable in the economy. Systemic economic change almost never arrives with banners, speeches, or official announcements. This is the first hook that often escapes public attention. If history teaches us anything, it is that major monetary transformations unfold quietly through incremental adjustments that seem technical, temporary, or even boring at the time. By the time the public recognizes that a system has changed, the change has already been absorbed into institutions, contracts, and everyday behavior. Monetary evolution works best when it is unnoticed. Policymakers understand this reality very well. Abrupt declarations create panic, capital flight, and political resistance. Gradual shifts, by contrast, allow adaptation. Rules are tweaked, definitions are adjusted, and emergency measures are extended just a little longer. What begins as an exception becomes normalized. From an economic perspective, this is not deception but risk management. Stability depends less on transparency than on continuity, even if that continuity masks profound transformation underneath. The second hook lies in how stress reveals direction. Systems do not change when they are comfortable, they change when they are strained. Rising debt levels, recurring financial crises, supply chain disruptions, and geopolitical shocks all apply pressure. In response, institutions make small defensive moves, diversifying reserves, adjusting collateral standards, altering settlement mechanisms. Each move appears minor, but collectively they signal adaptation to a reality the old framework can no longer fully manage. Silver's growing relevance fits precisely into this pattern. No authority needs to declare it monetary again for it to behave monetarily. When it is accepted as collateral accumulated as a strategic resource, or quietly prioritized in trade and industry planning, it is already performing monetary functions. Economics teaches us to watch behavior, not rhetoric. When actions diverge from official narratives, actions tell the truer story. Another hook is that markets often adapt faster than laws. Legal frameworks tend to lag behind economic reality, adjusting only after practices have become entrenched. Participants test boundaries, exploit gaps, and normalize new arrangements long before regulators formalize them. In monetary systems, this means that pricing mechanisms, settlement preferences, and asset hierarchies evolve first. Silver's role can expand organically through these channels without requiring any formal redesign of the system. Incremental change also diffuses responsibility. No single decision maker can be blamed for a systemic shift if it emerges from hundreds of small, defensible choices. A central bank diversifies reserves for prudence. A government stockpiles materials for security. A corporation hedges supply risk for efficiency. Each justification stands on its own. Together, they alter the architecture of the system. This diffusion is not accidental. It is how complex systems protect themselves from backlash. There is also a psychological dimension. Sudden change invites scrutiny and resistance. Gradual change invites adaptation. People adjust expectations slowly, recalibrating what feels normal. Inflation targets drift. Balance sheet sizes expand. Emergency tools become standard. In such an environment, the re-emergence of hard assets does not feel revolutionary. It feels practical. Silver's quiet repositioning benefits from this psychology. It does not demand belief, only utility. The most powerful hook is that systemic transitions are often recognized first through failure points. Delivery delays, inventory shortages, rule modifications, and temporary intervention signal stress. These moments are framed as isolated issues, but they often reflect deeper structural limits. When systems repeatedly rely on exceptions to function, those exceptions reveal the shape of the next system forming underneath. Economics also reminds us that legitimacy matters. Monetary systems endure not because they are perfect, but because they are trusted. When trust weakens, authorities compensate with complexity, opacity, and technical management. Over time, this creates distance between policy and public understanding. In that gap, alternative anchors gain appeal. Silver does not require explanation. Its value is intuitive. That simplicity becomes an advantage in a world where financial systems feel increasingly abstract and inaccessible. What makes this process especially difficult to reverse is that once adaptation begins, incentives align around the new reality. Infrastructure, contracts, and expectations adjust. Reversing course would require not just policy change, but unwinding accumulated behavior. At that point, inertia favors continuation rather than reform. Systemic change, then, should be understood less as a moment and more as a process. It advances through quiet accommodation rather than open debate. Silver's expanding relevance does not signal an imminent rupture, but an adjustment already underway. The economy is not announcing a new system, it is behaving as though preparation is necessary. And in economics, preparation often precedes acknowledgement by many years. So, are they setting up a new silver monetary system? My answer is this not in the dramatic, textbook sense, but in the practical, historical sense, yes, something is changing. Silver is being repositioned, not by speeches or official declarations, but by actions, incentives, and structural pressures. And when economists ignore those signals, they fail their responsibility to the public. The lesson from history is clear. Monetary systems evolve when existing ones can no longer manage inequality, instability, and declining trust. Silver's renewed relevance is not accidental, it is symptomatic. Whether this leads to reform or rupture depends on how honestly societies confront the limits of their current economic models. The real question, then, is not whether silver matters again. It is whether we are willing to recognize what its return is trying to tell us about power, about production, and about the future of money itself.